Today, the mortgage market just got interesting. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. NAB just lifted their mortgage rates, and the latest AFG data shows loan volumes are down, both of which are leading indicators for lower home prices ahead as credit continues to tighten and households have to pay more. And by the way, if you get value from our posts, please do consider supporting our work either by a Patreon, here's a link, or by making a one-off donation via PayPal. Again, here is a link. We really appreciate the support that we're receiving to help us continue to make great content. NAB today lifted its back book mortgage rates by up to 16 basis points, which marks the end of its initiative to hold rates lower. As we have been saying for some time, margin pressure is building, as illustrated by the BBSW and by LIBOR rates. And we expect more rises across the lending community, which will put more pressure on mortgage stress, which today stands at above 1 million households, according to our surveys. NAB's Chief Customer Officer, Mike Baird, said that the bank could no longer afford to absorb higher funding costs. NAB lifted rates on existing principal interest loans for owner-occupiers by 12 basis points to 5.36% and interest-only loans for owner-occupiers by 16 basis points to 5.93%. The bank raised rates for principal and interest loans for investors by 16 basis points to 5.96% and for interest-only investors by 16 basis points to 6.41%. NAB said its decision to keep variable rates on hold had saved 930,000 households around $70 million, and the bank said it had raised rates for principal and interest loans by a smaller amount in order to encourage homeowners to pay down their home loans sooner. Nice, but a meaningless touch in my view. Also today, mortgage aggregator AFG reported an 8% fall in loan applications compared with the prior quarter, according to their quarterly index, which was released today. Whilst it only represents the activity through AFG, it's a useful bellwether. The trajectory of the market is clear as the volume of investor loans and interest-only loans remains significantly lower than before the regulatory intervention. More households are choosing to fix their loan interest rates. AFG used the release as an opportunity to reinforce the role of mortgage brokers, remembering the Royal Commission, out soon, will likely opine on broker commissions. And they said Australia's home loan market is enjoying record levels of competition driven by mortgage brokers, with new lending data released today, revealing the market share of non-bank lenders is higher than ever. And latest industry figures reveal consumers are increasingly relying on mortgage brokers for help, with 3 out of every 5 mortgages in Australia now generated through mortgage brokers. As the financial services sector prepares for next month's release of the Financial Services Royal Commission final report, the AFG Quarterly Mortgage Index confirmed the crucial role played by mortgage brokers. It also provides a timely warning to policymakers the importance of ensuring the availability of credit and consumer choice do not become sacrificial lambs on the regulatory response to the Royal Commission recommendations. AFG said that they lodged $13 billion in home loan applications for the final quarter of 2018, down 8% on the prior quarter. Credit tightening, they say, is having an impact on volumes in every state. However, the Sydney and Melbourne property markets have been the most significantly impacted. The non-majors are becoming an increasingly important part of the assistance brokers provide to customers. Penetration has increased across all categories of borrowers, with non-major market share gains recorded for refinances, now 46.8%, upgraders 42%, first home buyers at 32.1%, and investors at 43.4%. New Mortgage and Finance Association of Australia, the MFAA data, shows mortgage broker market shares have grown to 59.1%, reinforcing that consumers are increasingly turning to brokers for their expertise as the market becomes increasingly complex. The record market share for mortgage brokers was the strongest evidence that consumers were more than satisfied with the customer service provided by brokers, they said. A spike in those choosing to fix their interest rates indicates borrowers are bracing for more bank-led rate rises, with quarterly volumes increasing from 90% to 23.1%. Noticeably, the major lenders' market share of interest-only and investment lending has stabilised after APRA's easing of caps. But do not be misled. Greater use of mortgage brokers underscores the need for better transparency in terms of commission disclosures and risks of conflicts of interest. I expect the Royal Commission to address this important issue, perhaps by banning commissions altogether or trails, or making the broker responsible for providing objective and independent advice similar to the financial planning sector. And the lower loan volumes and rising mortgage rates will combine to put more pressure on home prices, 20 to 30% peak to trough. Anyone? That's my favourite scenario at the moment over the next 2 or 3 years. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.